Hello, I'm Mansoor Mohyuddin, and this is Bank of Singapore Research. Financial markets have started the year strongly. The S&P 500 has increased more than 7%. US Treasuries have rallied with 10-year yields down from 3.9 to 3.5%, and the safe haven dollar has fallen. Investor sentiment has been boosted by better news from the US, Europe, and Asia. America's inflation rate appears to have peaked at 9% last summer. At the end of 2022, it was significantly lower at 6.5%. Similarly, Eurozone and UK inflation seems to be peaking after hitting 4-decade highs last year. Thus, hopes are rising that central banks will soon finish raising interest rates and tame inflation without causing recessions. Falling gas prices amidst a very mild winter have also raised hopes that Europe can avoid recession too. And China's reopening has made investors optimistic the world's second largest economy will start boosting global growth again. We think the early end of zero COVID policies significantly improves China's outlook for 2023. We have upgraded our GDP forecasts and now anticipate growth of 5.2% this year. Thus, we think China will be the only major economy in 2023 to experience faster growth than in 2022. We therefore maintain our overweight stance on Chinese equities. But we are more neutral on other major financial markets. In particular, we think the Fed and the European Central Bank will still be hawkish. Both central banks are aiming to return inflation to their 2% targets, not just to 3 to 5% levels. We thus expect the Fed funds interest rate will peak above 5% and the ECB's deposit rate will reach at least 3% this year. We therefore see the US, Eurozone and UK all suffering recessions or stagnant growth in 2023 rather than achieving soft landings. Our cautious view on the major economies, excluding China, suggests investors should be wary of this year's strong rallies in risk assets. In fixed income, we recommend being overweight US Treasuries and developed market investment grade bonds as safe haven hedges against recession risks. In global equities, we recommend an overall neutral stance outside Asia. For more information, please refer to our monthly investment guide titled Look East.